Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. During this session, we're going to be looking ahead to see what the key market moving events are that we're expecting for the coming week. And it is a busy week. We've got the ECB, the Federal Reserve, and the Bank of England all meeting this week. So it's probably one of the most impactful weeks that we've had so far in 2023. So I'm going to be going through what the major drivers are and also some of the big things to look out for. It is an important week, so do expect significant volatility this week in stocks and major currency pairs. Don't forget, as we talk about different entries, exits, all of this is from an educational perspective. The idea is you look over my shoulder, someone with a professional trading background, and you see how I go about making trading decisions. It isn't a signal trading service. Those of you who attend regularly understand how this works. There's a lot to look at this week. We will on Wednesday be looking at detail for the Federal Reserve interest rate decision, as well as the opportunities that I'm looking for out of the meeting. That'll be on Wednesday, and we'll do a deep dive into what's expected. We'll also be looking this week at silver. There's some potentials to look at for a breakout trade there, potentially, if we get a more dovish Fed. We also want to take an eye on what's going on with the yen. We'll look at some major levels of the S&P 500 briefly. I'll explain the dilemma that the Bank of England is going to be facing as they try to work out to prioritize tackling inflation or stimulating growth. And we'll be looking generally at stocks to see what the outlook is. Now, if you have any questions as we're going through, don't forget to type into the Q&A box or the chat box, and I'll keep an eye for questions. And I will look at any questions that I haven't answered as I go along at the end of the session. Now, without further ado, let's get stuck into a couple of things. So, first of all, we need to understand, morning, Gavin. Good to see you. Good to have you here. Good to have a good few faces here. Excellent. Kingsley, Johan, Alejandro. Welcome, Saeed and Gerald. I think it might be your first time joining us, so welcome to you. Big week for earnings as well, alongside these Federal Reserve decisions. We've got Google, Apple, and Amazon all coming after the close on Thursday. So that has the potential to really impact market sentiment. We've also got some big names, ExxonMobil, huge oil name in the US, and we have a number of impactful earnings data being released alongside the central bank decisions. So just keep your eye on that. If you want to take a screenshot of that, you can make sure you're ready for any earnings surprises. With the big names like Apple and Amazon, often the weightings of these individual companies in the major stocks are disproportionate. So an Apple weighting and an Amazon weighting has more impact than a smaller name weighting. So particularly in tech stocks like the NASDAQ, the earnings result for Apple can impact the whole index much more disproportionately than any other company. So you just have to be aware of that dynamic as you go through the week. Yeah, so you ask a good question about stocks and crypto. We'll have a look at that when we look at the Federal Reserve, definitely on Wednesday, and I will look at that now as well, and I'll explain to you what's going on there. Okay, so without further ado, what I'm going to do this week is I'm going to briefly have a look around major markets, point out some key tech, and then I'm going to get into the calendar because there's so much going on this week. So looking across markets, we see a more cautious risk negative start to the session. See that European stocks are mainly lower on the session. US equity future markets are lower, falling into support, and China's 50 is lower as China comes back from the Lunar New Year. The commodity market, quite mixed. We can see pretty flat action, but it is more tilted on balance to the downside. Copper lower, gold lower, silver's a little bit higher today. Iron ore prices are pushing higher. That's sort of more supportive for risk positive currencies if that carries on in the medium term. Natural gas sharply lower today. Brent crude and WTI crude fairly well supported on news that as China bounces back from its Lunar New Year holiday, the CDC chief didn't see a particular spike in COVID cases, so it does look like the worst is behind of COVID for China. That should be supportive for oil demand, but there's also concerns about how much Russian oil will be actually allowed into the market once the EU sanctions take place in February. Many analysts are tilted to the upside for oil over the medium term. You can see this head and shoulders pattern. So a break of that 82 region would be very attractive for a potential move up to that 92, 94 overhead resistance. So that's something to keep an eye on medium term. If we particularly see a dovish Fed on Wednesday, then that could be a good trade to be looking out for in oil markets. Bond yields are generally higher across the board. Nothing particular. The only thing to notice here is this 10-year yield band that the Bank of Japan have earmarked. Notice that the Bank of Japan is trying to keep bond yields in this plus 0.5 and minus 0.5 band, and that is why there has been some recent yen strength, because what investors are betting is they're betting that the Bank of Japan won't be able to keep this yield curve policy in place, that eventually they're going to have to respond to rising inflation. Tokyo CPI was up to 4.4% on the last print, and expectations are eventually the Bank of Japan is going to have to tweak this yield curve control policy and expand the band higher. So once again, the band's being tested at that 0.5% region, and that is why we've been seeing upside in the yen quite significantly from the start of the year. You can just see here the recent yen weakness that we saw into the end of last year has been fading as we've entered the start of the year, end of last year. Just expectations of the Bank of Japan potentially shifting from their yield curve policy has been supporting the yen higher. This is the yen basket, and you can just see the yen tracking higher, and you can see how much it fell, you know, in 2022. Huge falls in the yen, and now we're seeing some of that reverse, and expectations are that the Bank of Japan will eventually change their outlook. The major currency pairs have been quite flat on the day. Dollar index just staying underneath that key resistance at the 103 region and this near-term resistance level around that 102 region. So pretty flat markets, and really what markets are waiting for is what's going to be happening with the central bank decisions this week. So cautious trading, slightly more risk off, and we saw some high inflation data out from Spain earlier in the session, which obviously impacts expectations for more aggressive interest rates. So that's probably why we're seeing bond yields just moving higher in the session. Nothing tradable, just noting what we're seeing as we go through this session. So that's where we're at. Now let's look at the major decisions that we've got, the major economic data points. So we've got some Japanese industrial production retail sales out later, not likely to impact markets very much. We've got Australian job advertisements, retail sales, shouldn't particularly raise any expectations. The last thing that's on the RBA mind is the high inflation that we saw last week, and the peak higher in inflation has just increased expectations for the RBA to be more hawkish at their next rate decision. Do you see how the interest rate expectations for a 19 basis point hike went up after the last inflationary print? So you can see how the terminal rate's just been extended a little bit higher now after that inflation print. So, you know, any strong retail sales print here would just continue to confirm that more hawkish outlook we might see from the RBA. Nothing tradable, even if it is a good reading. Now, what's going to be interesting is the Chinese industrial profits and manufacturing PMI prints that are coming out for January. This will be impactful. Expectations are for a contractionary fall in manufacturing and services, but if we start to see more of an uptick in sentiment here, that could really boost China's 50, China's 300. Now, remember, the outlook for China has improved because they've pulled back from that COVID zero policy they had for much of last year. And that's why we've seen the China 50 just been, gaining as expectations have been growing. So that means that any return to this sort of 13,500 level is an excellent area for support for medium-term buying, okay, as things currently stand. And also we could see some support from this region with the data due to come out overnight, early Tuesday. If this is a really strong meeting, and say those purchase managers index, remember what they're being asked is what do they think about business conditions? What do they think the future's holding? If some of that sort of positive sentiment about a COVID zero pivot has got into the services data, and remember we saw, some big uptick in cinema screenings in China during the Lunar New Year holiday, there's signs that things are coming back to life. So if that does take place, then watch out for potential upside in China's 50, and that could boost sentiment overnight. Is it tradable? If you're up, yes, it is tradable in the China 50 futures market for sure. If you're not up, just realize it could positively boost sentiment. Now, if it's negative, I'm not expecting much downside because investors will look at that and say, okay, yes, maybe negative for January, but February should be more positive because things are looking up. So anything in expansionary territory would be really key. So if it comes in above 50 here and above 50 here, that's what we're looking for. Inflation prints coming out as well during the morning session tomorrow. Now, Germany's harmonized inflation print does have the capacity to impact the euro. Expectations at the moment are for 3 50 basis points rate hikes from the ECB this next 3 meetings in a row. 50 basis points, 50 basis points, 50 basis, that's 50 points for Jan and February and March. Now, what we need to be careful of here is a big deviation that changes that outlook. So if we see a huge miss in inflation, then you could see some of those hawkish expectations being priced out. So a big miss would constitute a headline below 8.7% and the headline below 8.2%. That will constitute a big miss. So that's what we're looking for. And if we got that big miss, that should result in euro downside. So euro-US dollar downside is one to look out for on a big miss when we get the inflation data out on the 31st of January. That's tomorrow. That would be a potential trading opportunity, but we would need to see a big miss in the data. New Zealand labour data is coming out in the evening. Now watch out for any divergence between the RBA and the RBNZ. Now the RBA expect to be more hawkish now after their last high inflation print. So if we see a big miss in the New Zealand data, that could start to open up a divergence between the RBA and the RBNZ. So the thing to be looking out for would be, let's see, let me just find a, you just take a look here, Aussie New Zealand dollar. You can see the Aussie's been gaining against the dollar recently after that high inflation print. What we'll be looking for is if we saw a big miss in the New Zealand data, that could open up a divergence between Australia's rate expectations and New Zealand's. So that will be the one to look for. And what you need to look for is this yield spread here. So if there's a big miss in the New Zealand data, then that would be suitable for buying the Aussie New Zealand dollar at market. Stops can be placed just underneath that 1.07200 region and looking for a run back up to that 1.100 area, maybe 1.1025. But look at the yield spread if you're not sure, which is the difference between the 10-year and the New Zealand 10-year bond yield. You want to see that spike sharply higher if we did see a big miss in the New Zealand data over Tuesday evening. So what we want to see, we'd want to see something like the employment change going, lower than 0.5%. We want to see the unemployment rate going above 3.6%. We want to see the participation rate falling below 71.4. So any divergence there between the RBA and the RBNZ, keep an eye on the New Zealand dollar. So we want to see negative data for New Zealand and more positive data for Australia. So that retail sales print that's coming out, ideally we want this to be positive and then the New Zealand data to be negative, and that could begin to open up an Aussie New Zealand dollar upside bias. The big event, of course, on Wednesday is the Federal Reserve meeting that's happening at 7 o'clock. Now, expectations are that there's a 100% chance nearly that the Fed's going to hike by 25 basis points. So that's what's expected. And you can see that short-term interest rate markets see a terminal rate just under 5%. So 25 basis points would take it to 4.6, 50 basis points, you'd see up to 4.875. But what that's telling us is that the Fed's getting very close to pausing interest rates. So that's why we've been seeing so much dollar weakness recently. And if you look at the dollar on a index basis, you can see the dollar keeps getting sold off. The dollar keeps falling because markets are beginning to think, okay, the Fed's going to be potentially more dovish and start indicating pausing. Now, a couple of things to note. There's a chap here on Twitter called Nick Timiraos. If you're not following him, you need to follow him. He's seen by many as a very influential Wall Street journalist who gives you a good indication of what the Federal Reserve are thinking. Now, the Federal Reserve are now in that blackout period, so they don't communicate. But Nick Timiraos has been saying quite a few things. Now, if you look at this decision here, just before the Fed's blackout period, Nick Timiraos said, Fed officials are preparing to slow interest rate increases for the second straight meeting, so that's a 25 basis point hike. And it says they could begin by deliberating how much softening in labor demand, spending and inflation they would need to see before pausing rate rises this spring. So right, so this is Nick Timiraos. He's saying that this is the beginning of a softening, right? So that's what he said on the 22nd of Jan. So Gavin, to ask you a question, do you think the Fed are likely to come across more on the dovish or hawkish side this week? It's really hard, but I do think they're more likely to be on the dovish side. Now, Nick Timiraos said this on the 22nd of Jan, which would say that, they're going to start to say, okay, how much more weakness in the labor market do we want to see before pausing rate rises this spring? So what this is telling us is that, yes, inflation is falling. And if you remember, we had that miss on Friday. I'll just use this Friday print here on the core PCE print. Now, the core PCE print is the Fed's preferred measure of inflation. So that year on year is down to 4.4%, headline 5%, down from 5.1%. And this is showing significant falls in the inflation data from the Federal Reserve. And if you just look at this piece here, I'll show you. Please excuse me for bopping around the screens. You can see that it's one of the smallest advances in more than a year. And this is the Fed's preferred method of inflation. Now, yes, it's still well above the Fed's 2% target, but it's moving in the right direction. So what that tells us is inflation's moving in the right direction. So that's why Nick Timiraos is saying was how much softening in labor demand, spending, inflation they would need to see, right? So now it becomes the labor market. And if you look at one of his latest tweets for this week, he says, stubbornly high inflation is finally easing as supply chain disruptions fade and interest rates at 15-year highs put the brakes on demand. But Fed officials have voiced unease that any disinflation might be short-lived because labor markets are so tight. So what this tells us is the labor market is crucial. Now, on Friday of this week, what do we have? We have labor data coming up at the end of the week. So that's non-farm payrolls coming out on Friday. So what that tells us, that we might see the Fed sort of being tentatively more dovish on the Wednesday meeting, but saying really we're going to be data dependent on the labor market. Now, if then jobs comes in on Friday, and there's a very big miss, if there's a very big miss on jobs on Friday, then that could result in a significant dovish reaction, upside silver, upside gold, downside in the dollar, upside stocks. So labor data is going to be very important for interpreting what the Fed do, is what my expectations are. So like the obvious trade would be if on the Fed interest rate decision on Wednesday, we'll cover this in more detail, obvious trade is say they're like, way more dovish, and they don't hike at all, and they start getting worried about, they start saying we've done enough, inflation's coming down, we're going to pause and see where we're at, then that would be good upside for stocks, a good upside for gold, significant downside for dollar most likely. But they're most likely to hike by 25 basis points and probably start stressing that they want to see some impact in the labor market before knowing what they're doing. So that's going to mean that that non-farm payroll print becomes really important. And if the non-farm payroll comes in really below market's expectations, below 139K for the private data, for the headline figure, if we see the headline come in below 125, and we see participation rate falling, and we see unemployment rate going above 3.7%, if we see that, then you'd expect to see significant downside in the dollar. So a lot is priced in for the Federal Reserve, that they're expecting just one rate hike, and you can see the expectations been quite flat during the last sort of couple of weeks since the Fed's blackout period. Just expecting a 25 basis point hike, which is what Tim Herrera said. Inflation data has been encouraging over the last few weeks, and that core PCE print has also been encouraging. So the most likely reaction is that we'll see no kind of major reaction, but it should be leaning on the more dovish side is what my expectations are. Obviously, I could be wrong, and I'm expecting them to put a lot of emphasis on the labor data. So that means the labor data coming out on Friday will be really important. So that's the way I'm looking at the Federal Reserve decision on Wednesday. And it's worthwhile noting where the S&P 500 is. We're at a major overhead resistance level. So if you just look at this level here, you can see that price literally moved up to this major resistance level and is testing it here. So if we get a dovish Fed, you expect the S&P 500 to go higher. If we get a more hawkish Federal Reserve, so in other words, if they say, we need to do more, we need to hike interest rates more aggressively, say they say we need to hike interest rates up to 5.5%, that's not what the market's pricing in. That would see dollar strength, and that would also result in significant downside in the S&P 500, and I'd look for a retest down to that 4,000 region. So that's definitely something to be looking out for. And if you look at it on the weekly chart, you can see you've got a really big sell area that price has moved into. So technically, we're a really rock solid area right now for S&P 500, and it's a natural kind of crossroads. Do come back on Wednesday. I'll cover it in some more detail, but that's roughly what I'm expecting. Now, on the Thursday, we have another significant decision, which is the Bank of England meeting. Now, Bank of England are expected to hike by 50 basis points. They're currently at 3.5. It's nearly seen as a 85+% chance of a 50 basis point rate hike. But one of the difficulties with the Bank of England decision is that at the last decision, and do check out the HYCM blog, we saw a divergence in response. So we saw a vote split of 6-3. 2 wanted to keep rates on hold. 1 wanted to go even more hawkish. And this shows the problem for the Bank of England. Do they prioritize tackling inflation, high rates, or do they prioritize stimulating growth, lower rates? And that's what we saw, this split in the Bank of England, because the UK is at risk of a stagflationary environment, and that stagflationary environment is negative for the pound. So the best opportunity would come most likely from a more dovish reaction. So if we saw the Bank of England look for an even lower curve and only hike by say 25 basis points and said that they're not expecting us going as high as the market's pricing, then we could see some significant volatility in the pound, and some of the recent strength we've seen in the pound on an index level could unwind, and you can see some of that index strength. Now we are sort of more looking at a more bullish surprise, but if there was only a 25 basis point hike, you'd expect the pound to fall. So you'd expect something like euro pound upside would be the go-to trade on that, on a 25 basis point rate hike. But you have to realize that there's quite a lot of uncertainties around the Bank of England at the moment, particularly due to the stagflationary risk. Now, the last inflation print out of the UK was very high, over 10%. So UK inflation is still showing signs of significant distress. So I wouldn't be surprised to see another vote split again. The expectations is no one's to vote for a cut, 2 unchanged, 7 for a hike. So we need to see exactly what happens. At the moment, expectations are that 7's going to go for a 50 basis point rate hike and only 2 are going to be unchanged. We then, not long after, had the ECB decision. Now, the ECB decision, expectations are for a 50 basis point rate hike, 79% chance of that, followed by another 50 basis point rate hike, followed by another 50 basis point rate hike to bring the terminal rate up to 3.5%. Recently, there's been a string of better than expected Eurozone data that's been supporting the euro quite nicely since the start of the year. And you can see the euro just been tracking higher. So the best opportunity here will be a very, dovish surprise. So if the ECB sort of starts stressing growth worries and they start saying, we're quite confident inflation is falling, unlikely to be after that Spanish data today, with Spanish inflation, coming in very high, it's unlikely that you're going to see the ECB doing that. Do check out this analysis from ING. It's worth looking at. And if they say, the medium-term inflation may return to target earlier than previously thought, and if they start getting more optimistic about the inflation target being reached, then you can easily see some downside in the euro-US dollar, particularly if they only hike by 25 basis points. Okay, but if they hike by 50 basis points but stress the worsening outlook, slowing eurozone growth, even though eurozone growth has been a bit better than normal, okay, that will move the euro-US dollar further down. The most hawkish would be if it's 75 basis point hike and they really try to get on top of inflation, and that would be significant upside in the euro. That would be, so the best tradable opportunities would be a 75 hike and pushing back against the peak rate that they think we might even be more aggressive. That's the best optimistic position for euro-US dollar upside. But if on Thursday the ECB hike by 50 basis points or even 25 basis points and start stressing a worsening outlook and a slower terminal rate or a lower terminal rate, that should support the euro-US dollar lower. Okay, at the moment they're quantitative tightening at 15 billion pounds per month, and if they say that can be paused, that would be more dovish. If they say that we can get it totally done and we can get it finished more quickly, then that's more hawkish as well. So the most likely outcome is they'll come somewhere in the middle, and you can see ING's base case there. So do take a screenshot of that. I've roughly covered that quite quickly for us. I'll just leave it up for another second. But that gives you the dovish and the hawkish expectations for later. Now, Saeed, you ask a good question. Saeed asks a good question. He says, is there any probability that stocks and crypto come down because of Fed tightening, but gold goes up because of war and recession risks? Generally speaking, what you want to look at for gold, yeah, sometimes you're right, Saeed. Geopolitical risk can impact gold, but generally speaking, and that hasn't been the case recently, but generally speaking, when you've got the dollar falling lower and real yields, as indicated by the tips, falling lower, that's supportive for gold. So, Saeed, what I would expect, although what you're saying is possible, and sometimes gold does go up on war risk, okay, and recession risk, you can see gold gain, particularly on geopolitical risk. So what you're saying is correct, okay? But sometimes it doesn't. So how do you work out when it does do that and when it doesn't do that? The best opportunity in gold for me is when you see the dollar and real yields moving lower. So you can see at the moment real yields and the dollar moving lower, that's supporting gold higher. When real yields and the dollar move higher, that pressures gold lower. So at the moment, the upside for gold remains. So if the Fed are more hawkish on Wednesday, you'd expect the dollar to surge higher, and you'd expect yields to gain. So you'd also expect real yields to gain higher as well, because the bond yield will go up, inflation expectations remain the same, so you'd expect upside in real yields, upside in dollar, and downside in gold if the Fed are hawkish. That's my go-to. Now, with Bitcoin, what you'd expect is if the Fed are hawkish, right, you'd expect downside in Bitcoin, because Bitcoin is really closely following the Nasdaq. Okay, so if I just see if I've got that here, let's see. All right, let's just look at BTC for a minute. Right, so you can see Bitcoin's been tracking nicely higher recently, but also notice that Bitcoin very closely tracks the Nasdaq. So if we see a dovish Fed, we'd expect that to support the Nasdaq higher, and that should also support Bitcoin prices. If we see a hawkish Fed, the Nasdaq should fall and Bitcoin prices should fall lower. Bitcoin gets grouped together with tech stocks. So whatever tech stocks are doing, you see Bitcoin tends to follow, and you can see that correlation can be really quite tight. Raising Nasdaq, rising Bitcoin, falling Nasdaq, falling Bitcoin, etc., etc. So I'd expect Bitcoin to be responding very much to what the Fed is doing. So it's not. Sometimes they do diverge, Saeed. So it's not a question that they always go up and down in tandem with each other. But because Bitcoin and the dollar and gold all have a dollar component, they're heavily influenced by the dollar. But gold's also influenced by real yields, and Bitcoin's also influenced by what the Nasdaq's doing. So looking at those figures, if you look at Bitcoin, the dollar, real yields, inflation expectations, and the Nasdaq, you can usually work out what you'd anticipate for Bitcoin and gold. But you do raise a good point, Saeed, and it's helpful to remember sometimes, you do get gold gaining on geopolitical fears. Hasn't been doing recently, but it can happen. I've seen it happen in the past. There can be a rush to gold. So you're correct to be just keeping that as a potential in your mind. All right, folks. Oh, thank you, Gavin. I'm glad that's helpful. I think really is for the Fed, it's going to be labor data now. And what the Fed want to see, they want to see labor market showing signs of weakening demand for jobs. And the Fed's got the problem is that there seems to be this number of workers that have kind of disappeared after COVID. So there's got this very tight labor market, and it's quite similar around the world. Workers seem to have decreased during COVID. I don't know if it's because, you know, lots of people took early retirement. That's the best explanation that makes sense to me. So until we start to see, you know, real weakening labor demand, the Fed are going to be concerned because they think that tight labor market will keep generating higher wages, because there'll be less people in the labor market and they'll be able to demand a higher wage. So that will keep inflation underpinned. So that's really, you know, what's going on. So good, I'm glad that was helpful. If you've got Bitcoin chart, just overlay NASDAQ on it. It just makes sense, and you'll see that, you know, can be really quite, you know, that's the hour chart. So you can see how, if you look on the hour chart, you see how close Bitcoin and NASDAQ correlates. It's not perfect correlation, right? But it's a quite a good one, just for a quick, easy proxy. Okay, folks, thank you all very much. It's been an absolute pleasure. Do take care, and I look forward to being back on Wednesday, getting ready for the Federal Reserve meeting. Thanks, everyone now. Goodbye.